Tiger brands have had a tough year. Its Nigerian misadventure shook investor confidence. The slowing economy has put pressure on household spending, and the food producer has had to face one of the worst droughts in decades as the time when the rand is battling against the US dollar. In February, their trade update warned that inflationary pressures on its raw material was likely to intensify over the next year or so. But let's get more insight on all of this. Moxima Gama joins us live from our studios in Cape Town to talk about the outlook for Tiger brands. She is our Finweek contributor. Moxima, thank you so much. We've mentioned all of the factors that seem to be working against Tiger brands at the moment. Has the share price reflected what is currently going on in terms of the macroeconomic situations?
Dumi, hi. Yeah, it really has. It's been kind of trading in a huge range band since 2014. And what is a bit concerning is that it's doing it on the top end of its bull trend, which just means, or is a sign that that bull trend is now getting exhausted and investors are now offloading some of the stock.
That looking at its share price, it's a fair reflection of its value.
Well, you know, technically, if you look at the monthly chart, it was a bit, it was trading on the third phase, so it was overextended. So seemingly investors are feeling at 400 Rand, it was too expensive, so they are offloading, as I'd mentioned. But fundamentally, it is a solid company. I mean, it's housing a lot of good brands, and, you know, which is very good for them for any future investments or acquisitions. And it's sitting at a market cap of about 6.5 billion, which is pretty good. So I wouldn't really completely write it off my portfolio. I'd probably be reducing my exposure but not writing it off. At this point, we would say it's a bit fair.
What would you say is the biggest risk that is currently facing that company? We mentioned a couple of factors, but the biggest one?
Okay, so besides the drought, which I mean all its peers have been experiencing, I think the biggest Achilles heel at this point was that that investment in Nigeria. They had to recently decide to stop refinancing it because it was driving them deeper into debt. They had to write off about 1.6 billion when they had initially invested it for about 1.2. So that is the biggest grapple at this point, besides the macroeconomic factors that you mentioned that is beyond their control.
Where is the growth going to come from, and where is it currently coming from at the moment, Moxima?
Okay, so it's housing quite good reputable brands, so that gives them some kind of pricing power, which then enables them to start generating returns on the upper end of their peer group. So that at least is helping the company keep afloat because of the Nestle's, and you know, it's just got a number of brands under in their portfolio.
Moxima, thank you so much for joining us this afternoon and giving us your outlook for Tiger brands. That was Finweek contributor Moxima Gama. Do stay tuned, because coming up after the break, we'll be taking a look at China's economic outlook and the impact that this has had not only on emerging markets but on developed markets as well. Stay with us.